In the early 18th century, the British joint stock company, the South Sea Company, was established, with ambitious goals to reduce the national debt, boost trade, and increase profits in the Americas. The company gained a trading monopoly, including the highly lucrative slave trade, known as the Asiento, with the Spanish and Portuguese empires. Initially, the South Sea Company offered an impressive 6% interest to stockholders, fueled by hopes of a trade boom following the conclusion of the War of the Spanish Succession. However, the actual trade opportunities fell short of expectations. Spain imposed taxes and restrictions on British trade, which hindered the company's profit potential. In 1718, King George took control of the South Sea Company, lending it an air of legitimacy and causing stock prices to soar. The company even began trading its own stock, encouraging and bribing others to invest, thereby further inflating prices. The situation escalated in 1720 when Parliament granted the South Sea Company permission to take over the national debt, purchasing it for £7.5 million. The plan was to pay the interest on the debt using the money generated from stock sales, or by swapping stocks directly for the interest owed. As speculation and demand reached a fever pitch, stock prices skyrocketed to an astonishing £1,000 by August 1720. However, this was a classic case of a bubble. Lacking solid fundamentals, the stage was set for disaster. In September 1720, the South Sea bubble finally burst. Stock prices plummeted to £124 by December, causing immense losses for investors and triggering widespread financial ruin. Suicides were reported, and public outrage against the company and its executives grew. In the aftermath, Parliament launched an investigation into the scandal, uncovering corruption and bribery within the South Sea Company. Archibald Hutchinson, who had accurately estimated the true value of the stock and voiced his concerns, was proven right. Robert Walpole, Chancellor of the Exchequer, played a crucial role in resolving the crisis. To prevent further catastrophes, the Bubble Act of 1720 was passed, forbidding the creation of joint stock companies without royal charter permission. Despite the disaster, the South Sea Company continued to trade until 1853. Albeit on a much smaller scale, other companies such as the Royal Exchange and London Assurance managed to survive and adapt. The South Sea Bubble of 1720 left a lasting mark on history as the world's first major financial crash and a prime example of speculation and inflated stock prices. It resulted in substantial losses for investors, financial ruin, and tragic consequences. The subsequent investors and reforms, led by figures like Archibald Hutchinson and Robert Walpole, aimed to prevent similar disasters in the future. Ultimately, the South Sea Bubble served as a cautionary tale, prompting stricter regulations and oversight in the financial world. While the South Sea Company's reign came to an end, its impact reverberated through history, reminding us of the dangers of unchecked speculation and the importance of transparency and prudent financial practices.
Uncover the shocking truth behind market bubbles in this eye-opening video.